Hey everyone, welcome back to the channel. I'm really glad you're here today because what we're about to explore has the power to change the way you think about money, risk, and long-term financial confidence. If you're serious about building wealth with clarity, not fear, not confusion, not hype, then make sure to subscribe and stay with me until the end. All right, let's begin. Part 1. Building the mindset of a truly intelligent investor. Before we talk about strategies, numbers, or market behavior, we need to build something much more important: your mindset. Most people think investing is about being smart, predicting the market, or discovering magical shortcuts. But real investors, the ones who last, the ones who grow, and the ones who sleep peacefully at night, operate differently. 1. The calm, patient, rational mindset. In investing, your biggest enemy is not the market. It's not inflation. It's not crashes. Your biggest enemy is your own emotions. When markets rise, people feel unstoppable. When markets drop, people panic. And every time emotions take over, mistakes follow. A truly intelligent investor is calm in both situations. You don't rush when things go up, and you don't panic when things go down. Why? Because you understand something most people ignore. Prices change. Value doesn't change as quickly. Your job is to focus on the business behind the stock, not the temporary mood of the market. Number 2. Investment versus speculation. The line everyone confuses. Let's make something clear. Investment is based on analysis, safety of principle, and reasonable returns. Speculation is simply betting on what you think will happen next. Most people say they're investors, but behave like speculators. If you buy something only because the price is rising, that's speculation. If you sell only because the price is falling, that's speculation. If you follow hype, trends, or social media predictions, that's speculation. True investment is boring in the short term, but powerful in the long term. You're not trying to guess the market. You're trying to build a future. Number 3. The market is a pendulum, not a calculator. The stock market is emotional. It swings from extreme optimism to extreme pessimism. When the market is too excited, prices rise above reality. When the market is too scared, prices fall below reality. This pendulum effect creates opportunities for you. When everyone is cheerful, prices are expensive. When everyone is scared, prices become discounts. You don't need to predict the next swing. You just need discipline to avoid following the crowd. Number 4. The margin of safety, your shield against mistakes. Every investor makes mistakes, but the intelligent investor protects themselves with a concept called margin of safety. It means you only buy something when its value is clearly higher than its price. This gap protects you from wrong calculations, market downturns, unexpected events, emotional reactions. Think of it like driving a car. You don't drive 100 kilometers an hour 1 meter behind the next car. You leave a safe distance. Margin of safety is that distance in your financial life. Number 5. You're not buying a stock. You're buying a business. Never forget this. A stock is not a number. A stock is not a chart. A stock is not a trend. A stock is a small piece of a real business. When you buy a stock, you're becoming a partner in that business. So ask yourself, would you buy the whole company at that price? Would you trust its management? Would you be comfortable owning it for 10 years? Is it profitable, stable, honest? If the answer is no, then it doesn't matter how popular the stock is today. Number 6.
Why crashes are not the enemy. Most people fear market crashes, but intelligent investors welcome them. Why? Because when everything becomes cheaper, your future returns become bigger. A crash is only a loss if you panic and sell. If you hold, or even better, buy more, you're using the market's fear to your advantage. Crashes are temporary. Value is long-term. Number 7. The defensive versus enterprising investor. Everyone falls into one of two categories. A. The defensive investor. Wants simplicity, wants stability, doesn't want to study markets every week. Focuses on safe, diversified, long-term decisions. This investor avoids stress, avoids speculation, and focuses on balance. B. The enterprising investor. Puts in more time, analyzes companies deeply, looks for undervalued opportunities, accepts more effort for better potential returns. Neither type is better. You choose based on your lifestyle, not your ego. Number 8. The role of discipline in long-term wealth. If there's one secret to building reliable wealth, it's this. Stay disciplined no matter what the market does. Don't chase trends, panic sell, fall in love with hype, try to get rich quickly. Instead, stay consistent, stick to your rules, keep your emotions under control, think long-term, always. Your discipline, not your intelligence, determines your results. Number 9. Why most investors fail, but you don't have to. People fail in investing because they seek excitement, act impulsively, follow predictions, try to time the market, buy without understanding, ignore risk, allow fear or greed to make decisions. If you avoid these traps, you're already ahead of 90% of people. Number 10. Your mindset going forward. If you adopt these principles, stay calm, think independently, buy value, not hype, ignore short-term noise, focus on the business, not the price, protect yourself with margin of safety, be patient, very patient, then you will become the kind of investor who doesn't just survive the market, you become the kind that benefits from it.
Part 2. The defensive investor, building a safe, strong foundation, and this part is going to give you clarity, a roadmap you can rely on for the rest of your life. Today, we're breaking down the mindset, structure, and habits of what I call the defensive investor. This is for you if you don't want stress, don't want complicated analysis, don't want to watch the market constantly, but still want to grow your wealth smoothly, safely, and intelligently. If that sounds like you, you're exactly in the right place. Alright, let's begin. 1. What makes a defensive investor? A defensive investor is not weak, lazy, or fearful. A defensive investor is wise. They understand something most people never learn. The purpose of investing is not excitement, it's stability. A defensive investor wants low effort, low emotional pressure, low risk of big losses, and steady, predictable gains over time. Think of it like gardening. You plant consistently, you water regularly, and you let time do the heavy lifting. You don't dig up the seeds every day to check if they're growing. 2. The biggest advantage of defensive investors. Most people lose money because they react emotionally, but defensive investors remove emotions by creating a system that works no matter what the market is doing. They focus on balance, safety, diversification, consistency, and because of that structure, defensive investors often end up doing better than people who chase high returns. It's ironic, but true. Slow, steady investing often beats aggressive strategies over the long run. Three. The core strategy, balanced asset allocation. A defensive investor's most powerful tool is balance. Instead of going all in on anything, they split their money between high-quality bonds, and B. high-quality stocks. Why? Because when one side struggles, the other side often helps stabilize things. This balance gives you smoother returns, less volatility, fewer emotional decisions. Protection during market crashes. It's like having two engines instead of one. 4. The 50/50 rule. One of the most reliable methods for defensive investors is simple: keep 50% in stocks and 50% in bonds, then rebalance once or twice a year. Let me explain why this works. When stocks rise too much, your portfolio becomes unbalanced. You calmly sell a bit of stocks and buy bonds. When stocks fall, you calmly buy more stocks at a discount. This system forces you to sell high, buy low, and never act emotionally. You're not predicting the market, you're responding intelligently to it. 5. Understanding bonds without complication. Bonds can feel confusing to beginners, but the defensive investor focuses only on simple, high-quality options. Heavy checkmark. Government bonds, heavy checkmark. Municipal bonds, for high tax brackets, heavy checkmark. Top-rated corporate bonds, heavy checkmark. Treasuries, heavy checkmark. Or a stable bond fund, they offer predictable income, lower volatility. A cushion during market drops. Think of them as the shock absorbers of your portfolio. 6. Why you should avoid high-risk, high-yield bonds. You might see bonds offering extremely high interest rates, but those rates exist for one reason: the company is risky. Defensive investors avoid junk bonds, low-quality corporate debt, confusing structured products, anything that promises too much return with no risk. If it sounds too good to be true, trust me, it is. 7. Choosing stocks the smart way. Now let's talk about the stock portion of your portfolio. A defensive investor does not look for the next big thing, chase hype, pick random companies, follow social media recommendations. Instead, they choose big, stable, financially strong companies with long histories, good balance sheets, consistent earnings, reliable dividends, solid reputations. These companies are not exciting, but they are dependable, and dependability is what truly builds wealth. 8. The power of diversification. A defensive investor holds somewhere between 10 and 30 different stocks, or simply invests in a broad market index fund. Why? Because no matter how good a company looks today, anything can happen tomorrow. Diversification protects you from bankruptcies, scandals, sudden collapses, unexpected downturns. You never want one company to control your entire future. 9. Dollar cost averaging, your secret weapon, one of the simplest and most powerful strategies in history is called dollar cost averaging, DCA. It means you invest the same amount every month, no matter what the market is doing. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, this creates lower average cost, less stress, steady growth, automatic discipline. Defensive investors absolutely love this strategy. 10. What you should completely avoid. To stay safe and successful, defensive investors avoid day trading, timing the market, buying at peaks out of excitement, selling at lows out of fear, complicated financial products, companies with huge debt, businesses with no profits, penny stocks, speculative hot sectors, social media trading groups. These traps destroy more wealth than anything else. 11. How defensive investors react to market crashes. Here is the most important part. When the market crashes, defensive investors do not panic, they do not sell, they do not react emotionally. Instead, they ask, are my companies still stable? Is my portfolio still balanced? If yes, they continue normally. If stocks drop a lot, they rebalance and buy more. This is how fortunes are built quietly while others panic. 12. Why this method works in any economy. People often say, what if the economy collapses? What if inflation rises? What if interest rates change? What if the market becomes unpredictable? Here's the truth: economies always change, markets always shift, crises always happen, but a well-balanced, diversified, disciplined portfolio outperforms fear every single time. This approach has survived world wars, depressions, recessions, bubbles, crashes, inflation waves, political chaos, and it continues to survive. 13. The psychology behind defensive investing. The real power of this strategy is not mathematical, it's psychological. because when you diversify, invest consistently, rebalance, avoid speculation, focus on stability, you remove the emotional roller coaster that destroys most portfolios. The defensive investor sleeps at night, the speculator doesn't. 14. When should you become a defensive investor? This approach is perfect if you have a busy life, don't enjoy studying markets, want stability, want long-term growth, want low stress, want protection, want a system you can trust. It's also perfect for beginners. You don't need special talent. You just need consistency. 15. A realistic long-term expectation. Defensive investing will not make you rich overnight, but over 10, 20, or 30 years, it becomes extremely powerful. Expect moderate returns, smooth growth, much lower risk, fewer mistakes, peace of mind. You are not chasing miracles. You are building a future. You now understand the full strategy of the defensive investor, how they think, how they build wealth, and how they protect themselves. In part 3, we will go deeper into the other side, the enterprising investor, the investor who wants higher returns and is willing to put in more effort, more research, and more skill. We'll break down advanced strategies, how to find undervalued companies, how to avoid traps, how to identify true opportunities, and how to act when others hesitate. Make sure to subscribe and stay tuned for the next part.
Part 3. The Enterprising Investor. Turning skill, patience, and strategy into real opportunity. This part is deeper, more strategic, and more hands-on. Think of it as the advanced side of investing, but explained simply, clearly, and without unnecessary complexity. Let's begin. 1. What is an enterprising investor? Unlike the defensive investor, who prefers simplicity and stability, the enterprising investor is willing to work harder. They want higher returns, deeper understanding, better opportunities, and more control over their decisions. But here's the important part. They don't take more risk. They take more responsibility. The enterprising investor doesn't depend on luck or predictions. They build their strategies on research, patience, and rational judgment. 2. The core mindset. Think independently. Most people follow headlines, emotions, hype, rumors, social media trends, and what everyone else is doing. The enterprising investor does the opposite. They understand something many never learn. If you want above-average results, you must think differently from the average investor. That means questioning assumptions, ignoring noise, looking deeper, waiting when others rush, and acting when others hesitate. This is how real opportunities are found. 3. Your main goal is finding undervalued opportunities. The enterprising investor's mission is simple. Buy strong companies at prices below their real value. Not hype, not speculation, not predictions, but value. You're looking for businesses that are stable, that are profitable, that are well managed, that generate consistent income, that have solid financial foundations, but are temporarily priced lower than they deserve. This gap is where opportunity lives. 4. Why the market misprices stocks. People often ask, if a company is undervalued, why doesn't the market price it correctly? The answer is simple. The market is emotional and impatient. Stocks become undervalued because of negative news, temporary setbacks, market fear, sector-wide panic, misunderstood earnings, short-term pessimism, or overreactions to small problems. The enterprising investor sees beyond these moments. They look at long-term value, not short-term emotions. 5. The tools of the enterprising investor. You don't need to be a genius. You don't need advanced math. You don't need Wall Street experience, but you do need curiosity, patience, discipline, and the ability to read basic financial statements. The key documents you'll use are balance sheets, income statements, and cash flow statements. From these, you'll learn, is the company making money? Is it spending money wisely? Does it have too much debt? Is it growing consistently? Is management trustworthy? These are the foundations of intelligent analysis. 6. The importance of long-term earnings. A company's true value is not created in a week or a month. It's created over years. So the enterprising investor studies multi-year earnings, long-term profitability, stability during recessions, and growth during normal years. Because short-term results can lie. Long-term results rarely do. You don't invest in a company for what it did last quarter. You invest for what it has proven over time. 7. Understanding debt the right way. Debt is one of the most important indicators of a company's strength. A strong company can carry some debt. A weak company collapses under too much of it. The enterprising investor checks the debt-to-equity ratio, interest coverage, cash on hand, and repayment schedule. Why? Because debt can destroy otherwise good businesses. When downturns come, companies with heavy debt fall the fastest, but companies with low debt or strong cash positions survive and even thrive. 8. Profitability matters more than popularity. Many investors chase cool companies, but enterprising investors chase profitable ones. They look for consistent earnings, stable margins, solid cash flow, and companies that grow slowly but steadily. A company can be popular without being profitable, and a company can be profitable without being popular. Guess which one makes you money? 9. Avoiding dangerous companies. The enterprising investor knows when to walk away. You avoid companies losing money every year, businesses with declining sales, companies issuing new shares constantly, management with a history of scandals, speculative industries with no proven demand, businesses built only on hype. You're not looking for excitement, you're looking for strength. 10. The power of special situations. Some of the best opportunities appear in unusual moments. For example, temporary scandals, restructuring, leadership changes, new regulation, panic after news, overreaction to earnings, temporary industry-wide sell-offs. These are moments where fear pushes prices too low. But if the company is fundamentally strong, these situations become opportunities. Remember, you profit from the market's overreactions, not from perfection. 11. The enterprising investor's checklist. Before you buy any stock, ask, is the company financially strong? Is debt under control? Are earnings stable for several years? Is management reliable? Does the stock offer a margin of safety? Is the price justified by the business value? Is the company profitable and consistent? Is the industry stable and understandable? If the answer is no to any of these, you walk away. Opportunities are endless. You don't need to force one. 12. Why patience creates profits. Enterprising investors don't act every day. They wait. Sometimes you wait weeks, sometimes months, sometimes longer, because the right opportunities don't come constantly. But when they do come, and you act with confidence, the results can be life-changing. Remember, Money moves from the impatient to the patient. 13. The role of emotional discipline. Even advanced investors lose money if their emotions take over. The enterprising investor remains calm, rational, independent, and analytical. They don't panic when prices fall, chase when prices rise, buy from fear of missing out, sell because everyone else is selling. You become the calm person in a room full of chaos, and that's where profit lives. 14. Why you should ignore predictions. Experts on TV don't know the future. Analysts don't know the future. Economists don't know the future. Influencers definitely don't know the future. The enterprising investor ignores predictions because the future is uncertain. Value is not. You are not buying predictions. You are buying businesses. And strong businesses remain strong regardless of noise. 15. Your greatest advantage. You do not need speed, secrets, insider information, or huge amounts of money. Your real advantages are long-term perspective, independent thinking, patience, and a willingness to understand businesses. These qualities outperform intelligence and technology more often than people think. You now have the full mindset and strategy of the enterprising investor, someone who looks deeper, waits patiently, and acts with clarity when others are confused. In Part 4, we'll bring everything together into a practical, step-by-step, actionable guide you can use to build your own long-term investing strategy. It will include portfolio structure, risk management, when to buy, when to sell, how to evaluate opportunities, how to avoid losses, and the long-term roadmap for financial independence.
Part 4. Your complete, practical roadmap to intelligent, long-term investing. First, you're serious about building real financial confidence. Second, you understand something that most people ignore: wealth isn't built through shortcuts. It's built through clarity. In this part, we're going to put everything together into a clear, actionable system you can follow for the rest of your life. No hype, no predictions, no unrealistic promises, just a practical, step-by-step guide to becoming a truly intelligent investor. Let's begin. 1. Start with one question: who am I as an investor? Before you invest a single dollar, you must know your identity. Ask yourself, am I a defensive investor or an enterprising investor? There is no wrong answer. Both paths can build wealth, both paths can protect you, but each requires a different approach. If you prefer stability, low effort, and long-term calm, you're a defensive investor. If you enjoy research, analysis, and finding opportunities, you're an enterprising investor. Decide who you are before you build your strategy. This decision becomes your compass. 2. Build a portfolio that matches your personality. Once you know who you are, structure your investments accordingly. For the defensive investor, your portfolio is built on simplicity, protection, balance, diversification. A classic example: 50% high-quality bonds, 50% diversified stocks, then rebalance once or twice a year. This alone can build long-term wealth with very low stress. For the enterprising investor, your portfolio is built on analysis, value, opportunity, deep understanding. A typical structure might include strong, undervalued companies, stable dividend payers, special opportunities, carefully selected industries, cash reserves for future buys. Whichever path you choose, the key is consistency. 3. The circle of competence rule. Here's something most investors underestimate: you don't have to understand everything. You only have to understand what you invest in. Your circle of competence is the area where you understand the business, you understand the industry, you understand the risks, you understand how the company makes money. The intelligent investor never invests outside this circle. If you don't understand how a company works, you don't deserve to own it, and that's okay. Find something you do understand. 4. How to evaluate a company before you invest. Here is your checklist: simple, clear, reliable. Before you buy any stock, ask, is the company consistently profitable? A strong business earns money year after year. Is the debt level reasonable? Too much debt can destroy even good companies. Are earnings stable or growing? Long-term consistency matters more than quick spikes. Are the profit margins healthy? A company should be good at making money, not just selling products. Is management honest and competent? Bad leadership will always create problems. Is the business easy to understand? If it's too complex, skip it. Is the stock price reasonable compared to value? This is where your margin of safety comes in. If a company fails one or more of these checks, walk away confidently. There are always more opportunities. 5. The margin of safety, your protection against the unknown. Mistakes happen, markets change, unexpected events occur. A margin of safety protects you from all of that. It means, only buy when the price is well below the company's true value. This gap protects you from being wrong, temporary downturns, market panic, emotional mistakes. Think of it as the seatbelt of investing. You don't realize how important it is until you really need it. 6. When to buy. The intelligent investor's timing strategy. Forget trying to time the market. No one can do it consistently. Instead, use these rules. Rule 1. Buy when value is higher than price. Simple, clear, powerful. Rule 2. Buy more during market pessimism. Great companies often become cheap during fear. Rule 3. By consistently using dollar cost averaging, invest the same amount monthly to smooth out volatility. Rule 4. Avoid buying at moments of hype. If everyone is screaming buy, step back and analyze calmly. Timing is not about predictions, it's about discipline. 7. When to sell. The most ignored rule. Most people don't know when to sell. They either sell too early or too late. Here's your simple framework. Sell if the company becomes fundamentally weak, declining profits, dangerous debt, management scandals, weak financials. Walk away. Sell if the stock becomes extremely overpriced. When price rises far above value, sell to rebalance your portfolio. If stocks explode upward, rebalance calmly to maintain your ratio. Sell if your original reason for buying is no longer true. This is the most powerful rule. Never hold a company out of emotion or hope. 8. The reality of market crashes. Crashes are not if. They are when. But here's something the intelligent investor knows. Crashes don't destroy wealth. Emotional reactions do. During a crash, weak companies fail, average investors panic, speculators get wiped out, short-term thinkers run for the exits, but intelligent investors hold, rebalance, buy more if possible, focus on long-term value. A crash is not a threat, it's a sale. 9. Your long-term roadmap, step by step. Here's the full strategy in clean steps. Step 1. Define your identity, defensive or enterprising. This determines your entire approach. Step 2. Build a diversified portfolio. No single company should control your future. Step 3. Research with discipline. Study financial strength, earnings, profits, and management. Step 4. Protect yourself with a margin of safety. Never overpay. Step 5. Invest consistently. Monthly investing beats emotional investing. Step 6. Rebalance regularly. This forces you to buy low and sell high automatically. Step 7. Stay calm during volatility. Let others panic, you stay rational. Step 8. Avoid speculation completely. No predictions. No hype. No shortcuts. Step 9. Focus on decades, not days. The longer your timeline, the higher your success rate. Step 10. Keep learning. The market changes, but the principles stay the same. 10. Your greatest advantages as an intelligent investor. The truth is, you don't need to be rich. You don't need special information. You don't need to predict the future. Your greatest advantages are patience, discipline, simplicity, common sense, emotional control. These qualities outperform intelligence, technology, and luck, because at the end of the day, investing is a game of character, not brilliance. 11. What the intelligent investor looks like in the real world. You might be surprised to know what a real intelligent investor looks like. They don't check prices every day, they don't brag, they don't panic, they don't chase returns, they don't follow the crowd, they don't try to get rich quickly. Instead, they buy strong companies, avoid hype, stay patient, think long-term, trust their process. These investors are calm because they understand what they own and why they own it. 12. The destination, financial independence with peace of mind. Financial independence is not just about money, it's about freedom, freedom from fear, confusion, stress, insecurity, emotional decisions, financial chaos. When you invest intelligently, you build a life where your money grows quietly, you sleep peacefully, your financial future is stable, you're prepared for all market conditions. That is the true reward of this journey. Part 4, the complete system. This brings us to the end of this 4-part series. You now have a complete understanding of the principles, strategies, and mindset that create long-term, intelligent investors. If you apply what you learned, consistently, patiently, rationally, with discipline, then you will be far ahead of the majority of investors out there. I will thank you for you subscribe.